The Bitcoin bonanza continues. I'm Lisa Bernhard with Reuters, and I'm joined today by Ross Mayfield. He is at Baird Private Wealth Management. Ross, Bitcoin hit another high today, soaring above $72,000. This comes on the news that Britain's financial watchdog said it was open to requests for crypto exchange traded notes. Now, we know that Bitcoin has taken off recently after the approval of exchange traded funds here in the US. What is the difference between ETNs and ETFs?
Yeah, it's a great question and an important one for investors. They're similar in the sense that they're tracking the spot price, or they're attempting to track the spot price of Bitcoin or any other asset that they might be involved in. The difference is that ETNs are notes or debt issued by typically a bank that is meant to track the price of Bitcoin or pay out some total return number at the end of its life. But it's an unsecured debt note typically, and typically doesn't own the underlying. Whereas an ETF, if it's a stock ETF, it owns the stocks. If it's a spot Bitcoin BTF, it presumably owns the spot Bitcoin. So the primary difference is the structure, debt versus exchange traded fund, and then whether they own the asset or not.
So what are the pros and cons of each? As a financial advisor, what would you recommend and to whom?
Sure. We typically proffer in ETFs in US and in the wealth management space in general. They're a little more tax friendly. Their structure is they own the underlying, which is really important. They tend to be pretty cheap. And the primary thing is you're not as exposed or exposed at all to the credit risk of the issuer, right? Because you own the underlying. With an ETN, which is an unsecured debt note, it offers a lot of the same benefits, right? Close tracking of a spot price or of an index, usually pretty low cost. But the difference is you're exposed to the credit risk of the issuing bank, which during times of stress could be a game breaker, a game changer. So those are the big differences, the pros and cons. And we typically in the US and with our clients tend to lean towards ETFs. There's also just a lot more of them.
Gold has also been rallying recently and hit an all-time high on Friday. Gold is often viewed as a safe asset, whereas Bitcoin is viewed as a risky asset. How can they both be rising at the same time?
Yeah, it's a real dichotomy, right? You have this defensive safe haven, and you have this risk-on, speculative, liquidity-driven asset in Bitcoin. And I think there's a couple, ideas. I mean, number one, pure momentum, right? It's kind of the continuation of the everything rally from the end of 2023. And just a lot of stuff is working right now. Stocks, bonds are working to an extent, and even a lot of these alternative asset classes are rallying. So there's a lot of dollars and a lot of momentum in the market. But I think why these two could be rallying at the same time, number one, they both would tend to, benefit from lower interest rates. And so if it's the market telling you that interest rates are heading lower or are rolling over globally, even if the Fed is kind of sticking to their guns that they want to be a little more cautious in cutting rates, I think it's a sign that rates, and to a lesser extent the dollar, could be rolling over. And then finally, they're both kind of in the alternative asset world, right? They're non-traditional currencies, or can be viewed as currencies, even if they're not typically used that way. And so to the extent that there's kind of a growing lack of trust in institutions and the US dollar, even if it's on the margins, you might expect it to benefit asset classes like gold, like Bitcoin, things that would proffer as currencies in some way, shape, or form.
You mentioned momentum. The S&P we've seen hit many all-time highs so far this year. How important is momentum to a stock rally?
In the short term, momentum is everything, right? Especially when it takes off. I mean, this rally is really driven by momentum right now. We have, an increasingly passive landscape where flows can dictate kind of short-term moves in the market. You're seeing a lot of money shift towards equities as this rally broadens out and really takes off. So in the short term, momentum is everything. In the longer term, it's corporate fundamentals. It's the old, I think Warren Buffett quoted Ben Graham, it's weighing machine versus voting machine. In the short term, voting machine. It's all about sentiment, flows, liquidity. And so in the near term, momentum is everything. But over the long periods of time, the corporate fundamentals and the economic fundamentals have to weigh out.
Stocks are down a bit today, and tomorrow we get the latest inflation data for February in the Consumer Price Index, which actually surprised a little bit to the upside for January, and stocks dipped then. Do you think that there's some profit taking today in anticipation, again, of a perhaps hotter than expected number tomorrow?
I think it's plausible for sure. I think profit taking in general right now, like you said, we're at all-time highs. Sentiment has gotten quite hot. It's a seasonally difficult period, and so it wouldn't surprise me at all if there were some taking profits, irregardless of CPI. And yet, you're right. Inflation has proven sticky. It has driven the Fed to take some of the rate cuts off the table that the market was expecting. And we could expect, an upside surprise tomorrow again. Some of that services inflation has been really sticky. Energy prices have rallied a little bit here, so the headline number could see some upside surprise. Overall, it's all set against a longer term kind of disinflationary trend that we think continues. But as for a 1 month period and with the market sitting at all time highs, that wouldn't surprise me at all.